I'm trying to tell you where the pain's coming, but the other side of pain is opportunity. I believe what I said earlier. This will be the greatest wealth destruction in real estate ever. Flip that over, greatest wealth generation opportunity ever.
Everywhere you look, people are saying the housing market is melting down and that it's 2008 all over again. They say the market's never been so toxic and it's all about the collapse. But what if that's not the full story? What if the headlines are wrong and ignoring what's actually happening beneath the surface? So today we're going under the hood on what's driving the current housing market and exposing some hard truths that many are missing. Joining me today on The Housing Nerd is someone who lived through the real carnage and crash of 2008. He bought when everyone was panicking and built his portfolio right in the middle of the 2008 housing crash. I think you're going to love today's Housing Nerd interview with Mike Zuber from One Rental at a Time. Hey, Michael, how you doing this Tuesday morning?
I'm doing well, man. I have this saying called "Every Day is Saturday," which is a place I hope all of your viewers get to eventually. It's really that day of the week where most of us can just do what we want with with whom we want whenever. And I get to enjoy that every day. So every day is Saturday. I often don't know what day it is. So I mean that when I say every day is Saturday. Feels like a Saturday to me.
Yeah, you're like, hey, we're going to go do this today. And you're like, oh, I forgot it's Sunday. They're not open.
Yeah, believe me. Sometimes I ask myself, where's all the traffic from? Oh, it's, rush hour. It's like, oh, I forgot what that's like.
Right. So to that end, let's start off and I like the viewers, the housing nerds, to understand what, a little bit about you and your investing journey in a nutshell.
Yeah. So my investing journey in a nutshell starts when I'm 30. Before that, I was very much of the mind of go to school, get a good job, climb the corporate ladder, retire at 65. I'm old enough to have invested in the .com craze, which is kind of mirrors the AI craze today. But I turned $7,000 into almost $200,000. I thought and actually said out loud that I was smarter than Warren Buffett. Hint, you're not. And that money quickly evaporated. I lost 80% of that, and before I cashed out and licked my wounds. And then I found Rich Dad Poor Dad, and it set me on a completely new journey in 2001. And that's where One Rental at a Time started, with the purchase of Norris Drive. And, lo and behold, I've twists and turns. The wife retired in 2015 and I retired in 2018. So 10 years for her and 7 years for me.
Yeah. And obviously I'll link to all this in the description, but Michael has an amazing book he wrote, folks, One Rental at a Time. I've listened to it maybe a dozen times. I'm more of a listener than a reader. And you always pick up something when you reread or re-listen to material. So I really encourage the folks out there that are trying to get into real estate to pick up this book.
That's such a nice thing to hear. And again, I want to set expectations. One Rental at a Time is not, I repeat, not a how-to book. It basically starts with the story I just gave you. Hey, I lost everything. I feel like an idiot. I'm depressed. I hurt my family. I find Rich Dad Poor Dad. And then what happens? Because when I wrote that book in 2018 after retiring. And the reason I wrote it is I actually got depressed, Jason. Figure it out. You're 45 years old. Every day is Saturday. You're not wanting for money, but you're depressed. I was depressed because I was, as I said earlier, I was raised to be an employee. And suddenly I wasn't an employee. I had nothing to do. I had no mission. I had no passion. I had no hill to climb. And I remember sitting at my kitchen table early in the morning, because I'm an early bird, drinking a cup of coffee going, oh my God, I have to go get a job. Not because of the money, but just for my sanity. And it was in that moment that I basically said, you're so stupid. What are you doing? And that was where the idea for One Rental at a Time came from, the book. And the book is just a journey. It's all the bad, all the good from that first house, which, the first tenant almost killed us. It's very distressing, to ultimately earning retirement. Yes, at the end of the book, there's, some lessons learned and do's and don'ts, but don't buy One Rental at a Time. Think it's going to give you the keys to the kingdom. It's just one family's story of going from complete and utter despair to financial freedom over 15 years. Not get rich quick, not get rich tomorrow, but get rich for sure. So that is the book.
Yeah. And maybe you're not giving yourself enough credit though, because in that book, you do detail the do's and don'ts to doing your homework, to researching your market. Don't buy an alligator. I think you repeat that maybe 10 dozen times.
It's the only picture in the first book. Don't buy an alligator. A buddy of mine drew that. Yeah.
Right. And so, again, just I would encourage anyone who's thinking of getting into real estate investing, experiencing a life change in their career, wondering how they beat inflation, to check this book out. So, having said that, in the book, one of the things that really grabbed me was your experience in the 2008 great financial crisis, housing crash. I lived in the Southwest of the US during that period of time. I was in new home construction. I was not in real estate, but I saw that complete insanity that occurred. I had a lot of buddies that got crushed, a lot of buddies that worked for Countrywide in Southern California and got hammered.
IndyMac, Countrywide. Yeah, it was ugly.
Yeah. So take us through what you experienced in 2008, what you saw in the market, and how you survived as a real estate investor during that time.
That is such a wonderful question, because not many people that have interviewed me kind of were in it as well. So the key to surviving 2008 was actually something I did in 2006. And in 2006, just to set the story, Olivia and I have 8 houses. Actually, it was 7 houses and a duplex. So that's what we had. And, we're millionaires again, right? We're millionaires. We're feeling pretty good, right? It's we're 5 years into this journey. The cash flow is starting to build, and we're frankly feeling really good about ourselves. But I see a headline from a gentleman named Bruce Norris, who at the time lived in Southern California, and he was going on the tour talking about California crash. That headline caught my attention. Why? Well, as I shared at the opening, I had a lot of money and then I didn't. I lost 80% in the .com crash. So the fact that somebody was putting out an article saying California crash, and oh, by the way, all of my real estate is in California, I was not going to do that again. So I spend the money, I think it was $300, may have been 200, but whatever, hundreds of dollars, to go to an 8-hour workshop with Bruce Norris. And if you don't know who Bruce Norris is, he's amazing. Go look him up. He's done some amazing work. He's now in Florida. And he goes through what felt like 1,000 slides. And I'm a numbers guy. I'm an accountant in econ, MBA. And Bruce was throwing out jargon that I didn't understand. But, Jason, one phrase caught my attention. And that was the affordability index. Right? Go look it up for your city, your state. But basically what the affordability index is for Bruce at the time was an early warning of pain ahead. Like all this 8 hours and all the slides, that was like my one takeaway. So, California crash, affordability index. So I go home and I research my market of Fresno, California. Lo and behold, Fresno is now sitting at the lowest affordability ever. It was like 15 or 13 or some silly low number. And I'm like, oh my God, I think Bruce is right. So what do we do starting in 2006 in complete either late 06 or early 07? We sell everything. And again, you can look this up in my book. I documented our first property, Norris Drive. We bought for 107. We sold for 269. And that was like in 4 years, right? The equity was amazing. But instead of selling and paying taxes, Jason, we did a 1031 exchange. And again, this proved to be very good timing, if not great timing. We took all of this fake equity and rolled it into a depressed asset, which was multifamily. Why was multifamily depressed? Because everybody was buying homes, right? I would turn people down for poor credit and poor income, and then they'd buy a home. So multifamily was crushed. So we get on a very, very active 1031 exchange. We go from 8 units to 80 in about 9 months, maybe 12 months. And that's how we survived 2008. Because when 2008 showed up, and it showed up in Fresno bad, by 2010, that property that I bought for 107 sold for 269, retrades at 75. 75. And yes, I tried to buy it, but somebody outbid me. I only wanted to pay 60. That's how cheap I went. But again, that's how we survived. Is we went to an event. We never stopped questioning ourselves. We learned, we dug in, and then we took massive action. And, then we did it again, coming out the other side. Right. So you just never stop learning. And when you find something, you take massive action. So that's what we did.
Yeah. So I looked up some stats, and for the housing nerds know that I love stats. So 15% down nationally and this is from a recent Lance Lambert article. Home prices down 15% nationally from 2006 through 2009. Fresno down 43%. What's weird is Ithaca, New York up 20%. And Columbus, Ohio, where I am, actually was down 8%. Obviously, real estate's local. We all know that. But yeah, so like you mentioned a couple of things there. And I'm like, oh, okay, this will really resonate with my viewers. Affordability. You saw that warning sign with affordability. So now let's talk about 2025.
Sure.
What differences are you seeing, or what similarities are you seeing from what you saw in 2006 through 2008 or so compared to now?
So this is an important concept. And again, so first and foremost, to stay on topic, the affordability index today is in the 20s. So it's not in the teens. It's bad. I'm not trying to say it's not bad, but it's not horrific, right? It's tough. And that's why transactions are down. Because again, it's just tough out there. However, and I had this conversation with Ken McElroy. What's really funny to me, Jason, is we essentially did the same nonsense in 06 that we did in 2022. Now, what was that? The reason that this crisis started in 08 wasn't because of 08 origination. It was because of 2006 loan origination. And housing nerds can look this up. In 2006, roughly half of all new loans were adjustable rate mortgages. Why? Because the story at the time, and everybody believed this, is housing only went up. So you will go get a 2-year teaser loan at 0.9 that is supposed to reset at 9.9 in 2 years. But don't worry, you'll just refi. And this is what Countrywide did. This is what IndyMac did. This is the nonsense of that era. And everybody believed it. So, that's how I sold Norris Drive for $269. Somebody got a teaser loan from Countrywide that ultimately blew up in 2010 because he couldn't refi, and then he couldn't sell, and then it retrades at 75. And what did we do in 2022? Well, we didn't do it in residential. We learned our lesson. But boy, oh boy, multifamily, syndications, stupid bridge loans, IO periods of 1 or 2 years. We are on the cusp of the greatest wealth destruction in real estate history. Now, the sheer quantity will not be nearly as bad as 08 through 2010, but the amount of zeros is going to be massive. We are seeing it now in Houston, Texas, where properties are now retrading at 50% or less than their last sales price. So what does that mean? Let's say you are part of a $100 million syndication in Houston, Texas. And let's assume your value add period didn't happen. You got hit with higher insurance and taxes, and you can't sell. You're going to get foreclosed. The bank's going to sell it for 50 cents on the dollar or worse, which means the 25 or 30% equity, gone. Banks are going to take a 20% haircut, gone. So unfortunately, we didn't learn our lesson. We did the same thing. Short-term debt, variable rate debt. We assume prices only go up, and the momentum is crazy. I went to an event in San Jose, California in 2022, and I was the old, boomer, one rental at a time guy. And there was some 28-year-old syndicator who never owned anything, who was talking about Ohio, which he never lived in. And he was able to raise like $25 million that day. That was the nonsense of the era and why we are having so much pain. So the answer to your question is the greatest wealth destruction that's ever occurred in real estate has already started and will likely take 18 months to 24 months to play out. because pain is coming.
So, a couple of questions there, follow-up questions. So I know firsthand what the syndication pain is like. Without giving all the details away, I'll just tell you that my wife and I invested in several syndications over the past 5 years, and those have not worked out well. We weren't running the syndication, but we were one of the limited partners.
Yeah, you were an LP, not a GP. Yeah. LPs are going to get wiped, man. That money's gone. Toast.
We fully plan on that money being gone. Good news is got all of it back, the original investment, but didn't make anything. So the money kind of just was, inflation, obviously, whatever. It wasn't.
So I would consider yourself lucky.
Yes.
I know plenty of people that have invested somewhere between 5 and 15 syndications. And just to take a rough average of 10, and again, this is from hundreds of people, somewhere between 4 and 6 are absolute garbage and we're 0. Two of them are like, I might get half my money back. Like they're hoping for half. And then the other 2, they're going to kind of break even. But they have to hold longer, right? There was a 4-year hold. Now it's an 8-year hold, right? It's all bad. And, it's sad. I mean, I know people that were set financially that lost 7 figures by trusting, syndicators. And that's what happens. It does have bad. It's always the lending. I wish more people understood it's the debt that blows up. The asset of real estate over time is fine. But if you have a short term, this is Dave Ramsey's lesson. The reason Dave Ramsey hates debt is he was a multimillionaire house flipper who leveraged 90-day debt. That's like holding a gun to your head and saying, it's like Russian roulette where there's 5 bullets out of 6. You're eventually going to be dead. It's always the debt, people. Yeah. And for those that don't really, we don't talk about syndications a lot on my channel, but basically you're pulling people's money together to multiple investors together to buy a commercial property. Usually, a lot of times it's multifamily. It's the same thing as a duplex, just with more people and more zeros. It's the same thing. There you go. Yeah, great way to describe it, Michael. Yeah. A lot of people are in the process of getting crushed. So the question I have though is, because the units that I invested in and all the units that I own are pretty much C-level units, C-class units. Sure. Personally, I'm not seeing a lot of pain yet when it comes to properties available in that. Because I'm like, man, I really want like a 10 to 15 unit building, do a 1031 with some single family houses like you were doing. But I've marketed a lot to sellers. I'm on the MLS all the time. I'm just not seeing the deals yet. It's coming. I mean, I'm seeing. So this is how it's going to go. And again, I'll give you a real life example. I think it's in the book. There was a property we still own today. It's 18 units. We start tracking it, I want to say in 2008. And it was listed for 1.44 million. I come to find out, why was it listed at 1.44 million? Because that's what the owner paid for it. And basically the bank said, you got to sell it. Right. So this is extend and pretend, but way back in 2008. And a couple of things happen. Lots of properties will get listed, but they'll get listed at what turns out to be stupid prices. Then what happens is the owner stops fixing things. Why? Because they know they're going to lose it. So they start doing band-aids at best and leaving vacant units and taking anybody that with a heartbeat. And, fast forward 2 years, after, watching it literally for 2 years. So what would that be, like 700 days on market? The bank takes it back because now it's just a total slumlord pigsty, just crap of a building, which it started out pretty good. And we end up going directly to the bank, buying it for $700,000, 100% financed by the bank, by the lender. All we had to do was put $50,000 in an escrow account for repairs, which we would have done anyway. And we pick it up. So the answer is, it's just started. This is just math. It's coming, right? So to be clear, it is not coming to residential. Residential has 30-year fixed rate debt. The debt's not going to blow up. But 5 and above, it's coming. And I'm already seeing it. I'm seeing it just like '06. There are more listings at stupid prices today. It just takes time for the bank to go, that's enough, foreclose. It's coming. You and I look for, and again, to be clear, like I'm trying to tell you where the pain's coming, but the other side of pain is opportunity. I believe what I said earlier. This will be the greatest wealth destruction in real estate ever. Flip that over, greatest wealth generation opportunity ever. So like you, I will do exactly what's in my book. I will find a time to sell residential stuff, which is safe and secure, and 1031 into more real estate. So I expect to 10x my portfolio in the next 2 years, right? Maybe not 10x, maybe 5x my portfolio, because I've been here before. I know how the movie ends. It just takes time.
Yeah, huge opportunities coming. No doubt. I keep telling myself that, and I keep hunting. I keep making offers. The other thing, I am also surprised that I haven't seen more pain with similar landlords to myself that, and I'll be the first one to admit, some of the loans that I have, some of the debt that I have is not 30-year fixed debt. Although oddly enough, it's adjusted to a point that it's okay now. It's come down a little bit. But recently, but at the same time, I got to think there are a lot of operators with, triplex quads that are going to get crushed at some point, I would think, from mismanagement or whatever. And I always presented on my channel, Michael, that like those opportunities because I'm pivoting now more into residential, I guess, but for our discussion, but I'm thinking like, man, those are opportunities for people to break into real estate with house hacking. It's something I never took advantage of as a younger adult, but I wish I had. So before I get to that more though, let's talk more about residential. That's sure. My channel, they're geared toward the residential real estate more. Like, why is commercial not like residential when it comes to this time around for the supposed biggest housing crash of our lifetime that you hear a lot of folks talk about?
The debt forces behavior, right? It's not always a great time to sell. Like today, it's funny. I think it was Fortune just put out an article that said it's 77% of Americans think it's a bad time to buy, which I think is quite frankly crap. And I mean what I'm about to say with every fiber of my body. This is right now the best time to be a buyer of investment real estate in the last 12 years. Let me tell you why. As a buyer and investor, what do you want? Well, Jason, I want more options, AKA more inventory. In most of the country, we have significantly more inventory today than we've had in the last several years. Fact. Number 2, as an investor, I want less competition, not more. Given where rates are and given the negative sentiment and given the uncertainty in the economy, we have less competition than I have seen in the last 12 years. And then finally, the nail in the coffin. I want to do great deals, which means I need to find motivated sellers. I have been doing this for 20 plus years, and this is the second easiest time to find motivated sellers. I'm not saying it's easy. I'm saying it's the second easiest. All you have to do, track days on market, write disrespectful offers, and follow up. This is a numbers game. Do the work. Lastly, on this topic, Fortune is wrong. It is not a bad time to buy. It is the best time in the last 12 years. However, what it is it's the worst time to sell a home in the last 12 years. If you are a flipper, you're screwed. If you're a wholesaler, you're screwed. This is a horrible time to sell. It's an amazing time to buy.
Yeah, it's amazing that you just mentioned that about the wholesalers and the flippers, because what I am seeing, I just interviewed one of the largest wholesalers in the Columbus area, and that video will be out in the next few days. And he was very specific and said that, and you can see it in the numbers, where inside the metro area of Cleveland, Columbus, Cincinnati, I suspect many other metros, Michael, you can see like older homes built around 1900 to 1920, 1930 are rotting on the market because they're half flipped. Yep. Or they are flipped, but they want 300 grand where the market will only hold 225. And if that's where all the inventory is being like, that's where all of it's exploding.
Yep.
And he admitted, he said a lot of my investors are getting crushed.
Yeah.
He basically said what you said. He said, now is a great time to find an opportunity, but a bad time to sell. It is. So, I mean, maybe at the end of the day, that's why we're seeing new listings falter. Maybe that's why we're seeing inventory actually start to fall now nationwide, because people know it's a bad time to sell and the switching costs are high, right? So,
yeah. So again, why are we seeing bad time to, why are we seeing inventory down? Well, there's a couple of reasons. First and foremost, it's that time of year. Folks, real estate is a cycle. If you don't realize there are seasons in real estate, you're not paying attention. Real estate inventory always goes down in the winter. Hello, we're headed there now. However, what the real issue is, and I called this out early on my channel, is, and you brought it up in your example of 300, but it's really worth 225. There's this notion of wish pricing. And, it's just unrealistic pricing, right? It's not meeting the market where it's at. And as a seller of a $300,000 home that's really worth 225, you have options. A, you can just keep it listed and let it age out and expire. B, you could take it off the market and try again in the spring. C, you could take it off and make it a rental. I'm seeing more and more accidental landlords today than I've seen ever. And then lastly, you could lower the price and meet the market at 2.25. Those are the only options. That's why it's a horrible time to sell. It's a great time to buy.
Yes. So are you, when you think about the average seller out there who's trying to sell their home or thinking about it, you do a great job on your channel of talking about want to sell versus need to sell.
Correct.
Massive difference. And obviously seen a lot of want to sell. And I think that drives a lot of people insane. I think a lot of the crash brothers or crash bros, which is the correct term, I guess, they don't understand. And maybe they do understand. That's probably not right. They do understand, but they're very upset about the fact that there's a lot of landlords, a lot of homeowners that just don't need to sell. So they're going to put their home on the market and test the market. When it doesn't sell, they're going to take it off, right? So yeah, I think we're seeing that.
I think, Jason, you are very kind, and I am not. I think most crash bros are simply evil human beings who pay their rent by crushing hope. And I mean that every word of that. They are pure evil. There are a few bears, and I do think there's a difference between a bear and a doomer. I think most crash bros are doomers who are talentless hacks who couldn't make it as agents or mortgage brokers that pay their rent by creating fear and killing hope. But as far as the housing bears, I think most of them don't understand why today's not 2008. The bears, and this is why I've studied real estate back to 1970. So I have 55 years of history and realized and called it out very early that we are going to have a housing crash in transactions, not in price, right? That's one of the trophies I got because I was right. I called it early and I said, we're going down 40%. And boy, did the crash bros try to eat me alive. Well, hello, I was right. You were wrong. But at the end of the day, real estate over 55 years is a lot different than the GFC. And as we talked about at the opening, the debt structure in 06 versus 2024 is very different. It's just not the same setup. And that's why I think a lot of housing bears don't get it, and why housing bears are wrong is they only go back to the GFC. They're like, that was the most recent housing cycle, and all housing cycles must look like that. No, you moron. Get a book. Go look at the St. Louis Fed back to 1970. Shoot, it goes back to 1950. And realize that 2007, 8, 9, 10, 11 were odd, not the standard. So I think housing bears are blind to anything pre-08, and doomers are just evil human beings who don't care about their followers who have crushed hope and pay their rent in the most disgusting way possible by creating fear.
The way that 2000, the GFC played out, something that struck me from your book also was that prices went up in the run up to the GFC, nearly the same amount as they have recently.
Correct.
But rent didn't increase.
Correct.
And
Correct.
when I heard that, I was like, wait a minute. I was running when I heard it. Yeah. So when I listened to the books and I was like, what? Wait, stop. And my dog's like, what are you doing? Why are you stopping? And I'm like,
get a cramp?
I got to stop. Yeah, I've got to save this clip. I'm like, that, I never knew that. And then I went back and I looked at the data this morning and I was like, wow, he's right. Like, so home prices exploded. Rent and inflation did not.
Yeah,
So
I'll give you real.
Housing was like an outlier.
Yeah, I'll give you an example from the book. So my first property, Norris Drive, you can look it up, 1818 Norris Drive East, 93703. I buy it for 107. It rents for 295. I'm sorry, it rents for 1,095. So barely the 1% rule. When I sell that property 3 years later, go on Zillow, it sells for 269 or 263, something like that. It's still rented for 1095. Why? It was the debt. Remember those teaser loans, right? Somebody could buy the property at 2, whatever it was, and with a 0.9% 2-year teaser loan, the payment would be $1,000. It was the debt that blew up and shelter costs, and that was very different than this time, right? And you're absolutely right. It was a great catch. Nobody else has ever brought that up. But the fact that we saw, Fresno was the #1 market in the country 2 years in a row, right? I mean, just think about it. In a little bit over 3 years, it goes from 107 to 269. That is a hell of a run, right? More than 100%. And rent didn't budge. It's wild to think about.
Yeah. So this time rent exploded along with prices. When I say this time, I mean, just going to use 2020 through 2025.
Correct.
And everything else has gone up a lot in cost too. So when I hear people say, hey, housing is going to roll over significantly, like they're saying, well, somebody that I follow a lot, I heard her on your channel last year and almost drove off the road when I heard this. Last November, you had Melody right on your channel, and she predicted, it could have even been December. She said home prices would be down 5% last year compared to 2023. And we were nowhere close to that, obviously. We ended up being up year over year. And then she said home prices would fall double digits in 2025. That hasn't happened. But she's still standing on her hill saying, hey, home prices are going to fall further than they did during the GFC. We're going to revert all the way back to like 2010 levels or something. I don't know. And I look at that and think, but everything else is super expensive comparatively. Why do you think just housing will go down, but everything else will be super expensive? I don't. So I've think about that.
So I've had Melody Wright on my channel a couple of times, and I have her on my channel, or I've had her on my channel because she has a very unique historical perspective of the debt market. That's where she lived. That's where she cut her teeth. She went through the '08 crisis much like I did. She was up close and personal with families losing their homes. So Melody Wright has a very unique perspective on a part of the market that I do not have. And I respect people who have experience that I don't have. And, you know, I had followed her for a long time. I no longer do. Why? Well, first off, she called for a negative 5% crash in 2023. Wrong, and she didn't admit it. Then for it was 2024. I don't want to be wrong. So it was 24, not 23, negative 5. I called her on it in that video, and she basically said, oh, the data will be revised. I'll be proven right eventually, which didn't happen. I'm like, okay, whatever. And then she called for, I believe, a national decline of 9% in 2025. And we are up for the year. And there's just not enough time in the sun to get to negative 9%. So it's not happening in 25. So Melody Wright has been wrong for 2 years in a row. What I have seen her do over the last year, and why I no longer consider speaking with her, is she has surrounded herself with some of the most disgusting real estate crash bros on the planet. And if you hang around dogs, you're going to get fleas. And I believe she now has realized that there is money to be made by producing daily fear. And I just watched one of her videos recently where she tried to call out Housing Wire and Logan Montashami specifically for basically being a paid shill, which I think is disgusting, because I could say the same thing about you. And oh, by the way, Logan has been a lot more right than you have. The last thing, again, because I respect her area, like I'm a tourist in the debt market, right? They use vocabulary and volume. Like I have no idea. She is rightly so an expert in that market. However, in the video that I just watched for her saying this is going to be worse than '08, I took some of that and I took it to a Wall Street guy that I know that's got 12 years in the debt markets. And I'm like, okay, this is what I'm hearing. You know, somebody who is deep in this tells me it's going to be bigger than '08. Tell me why she's right or why she might be wrong. And basically, without, going too deep, the first thing to understand is in the '08 crisis, it absolutely started with subprime that then pricked Alt A and ultimately went to prime. What people don't realize about today is the debt market, the subprime market, is stronger than it's ever been. Why? Because frankly, they don't do a lot of them. There's this other thing called the debt market called private credit, right? Think of shadow banking. So again, the subprime section of mortgage, while bad, I think delinquencies are at 6% today or almost 7%, which again is bad, but it's not like what's going to be from '08 because a lot of that really risky stuff went to the private debt market. But the private debt market on a scale is 1/4 of what we were talking about in the other crisis. So again, we will absolutely have a rise in foreclosures. We will absolutely have people lose money on their homes. But to say that this is going to be bigger than '08 is clickbait, headline grabbing farce. And let's not forget, you've already been wrong twice. And you're leaning into this narrative that it's going to be worse. Like it's always worse. It was -5. Now it's -9. Now it's double digits. Then it's worse than '08. Come on, give me a break. You're not seeing the bigger picture. And oh, by the way, let's just assume the debt market really started to blow up. Do you not realize we know how to fix that now? Slash rates to zero, issue TARP, bingo bango, pain stopped. I mean, I get it. I respected Melody Wright. I've read her Substack. But over the last year or so, she is starting to socialize frequently with some of the worst evil crash bros on the planet. And if you hang around dogs, you get fleas. That's my opinion today.
Yeah, understood. And I think what's sad is that it's easier by human nature to not do anything versus take forward action. I think she gives people, and the crash bros give people a lot of permission to sit on the sidelines and not do anything.
Well, I think that's
kind of validate their inaction.
The reason I believe crash bros are evil is exactly that statement. Crash bros crush hope. I have never said in the two interviews, it's really funny because my best two videos on my channel are with Melody Wright. I don't know if you've ever seen this, but I have two videos, that produced over $1,000 in AdSense, both with Melody Wright. My next most popular video is like $300. So they're not even close. Melody Wright is a headline grabbing, person who will drive feeds. But, now you know why. Because I think the video with her was called Housing Bloodbath. And again, she's very smart. She's very, very smart and tells a great story. And that's why people listen. But again, the reason Crash Bros and now Crash Sisters, they crush hope. They tell you to do nothing. And that's how they don't get sued. The reason Crash Bros don't get sued is because they're not telling you to make an investment, right? People out there all the time get sued for investment advice. They're telling you to do nothing. That's a nice way to step around not getting sued, I guess, in action. But yeah, Crash Bros crush hope. I believe Melody Wright is now crushing hope. And, you know, I mean, all you got to do is look at the track record. -5 didn't happen. In fact, said, and on the video, it'll get revised down. I'll be proven right eventually. Nope, that didn't happen. Oh, it's going to be worse this year, down -9. Nope, didn't happen. Okay, all right, just, you know, rinse and repeat. Worse next year, worse next year, worse next year. Okay, I got it. Same story, different year.
Yeah, I think her latest narrative was like, she keeps saying it's about to get really bad. Buckle up. But I'm like, what is that? How's that help me? Like, I don't know what that means.
Well, so this is played out. So let's say, because one of the things that she called, and again, I love giving her credit. I think Melody Wright correctly called the FHA shadow game. And I think she's absolutely right. She called it early. She deserves absolute credit for this. And if you don't know what was going on with FHA loans, they were basically doing these, you know, revisions, and they were, you know, basically stopping foreclosures and doing these loan workouts. And there are people that have gotten 2, 3, 4 workouts. Here's the deal, Jason. Those should have been foreclosures. It happens. It's part of the cycle. If you buy a house and you can't pay, you get foreclosed. It's part of the deal. It's in the note. But for a couple of years, we just didn't let that happen during COVID. So we pushed all these bad loans back. And now, as of October, foreclosures are going to start. So Jason, you could take it to the bank. In the next 3 to 6 months, we are going to see a rocketing higher of FHA foreclosures. And it's going to look nuts on the chart. And the Crash Bros and Crash Sisters are going to celebrate. We're right. But guess what? It's just like a garden hose. If you crimp the garden hose hard enough and then you let it go, it floods out and then it eventually backs off. So it's going to skyrocket and it's going to come right back down. But don't worry, the Crash Bros will celebrate. They will do videos declaring victory. And then we will just go down when the rush is over.
Well, and they present awesome opportunities. I mean,
well, exactly. And they'll never
right?
say that. They'll never talk about opportunities.
Yeah. And I don't get that part. I'm like, okay, if foreclosures are coming, that's good for people, not only investors, but I know several people that purchase foreclosures with tenants in there.
Oh yeah.
Evicted the tenants.
Absolutely.
And then moved into the house, and they've got a house that they spent $200 on in a neighborhood where houses are $400. And you're like, that to me, it's a huge opportunity.
I'm telling people, I mean, Jason, to like for the first time in I don't know, 10 years, to, you know, I got a lot of people who do marketing, like outreach. I'm telling them to go get the NOD list, right? Notice of defaults. It's time to start marketing there, because I think Melody Wright is correct. But again, if it's coming, how do you take advantage? And that's the thing that Crash Bros never talk about. They never tell you, okay, strike. It's just, you know, again, they're evil. They're just evil people crushing hope. It's sad.
Well, and speaking of that, so the one part that I've kind of really started to dive in on is the 15 million vacant home theory. So there's a theory out there that there's 15 million vacant homes, and I thought, well, let me look at the data first. What I discovered, and by the way, the narrative for people that don't understand is that 15 million vacant homes are out there right now. There's a silver tsunami of baby boomers that are going to die, and they're going to leave all these, I guess the theory is they're going to leave all these move-in ready free homes on the market that people can just go and take. But when I dove into the data on the vacant homes, it's 15 million vacant units, not homes.
Correct.
And as you read the footnotes, you can tell they include multifamilies, obviously. So if you got a building with 100 units and it's done and only half of them are leased right now because they're just, you know, filling it for the first time, 50 of those units are counted as vacant. That's way different than 15 million single family homes. By the way, there's always been millions of vacant homes.
That last point is the important point. Because again, a doomer and a Crash Bro will take a story, take a number with no context and just spin a scary story. It is really easy to spin a story around 15 million homes vacant and paint a picture of all this impending doom. But if you step back and you go, how have the vacant homes been over the last decade or 2 decades? And you realize it's always been 15 million. and we haven't had a housing crash, you should throw that metric away because clearly it means nothing. It's just another crappy metric with a partial story intended to create fear and crush hope. It's the game they play. They are talentless hacks who are creating fear and crushing hope. And they just do it every day.
Agreed. And I want the viewers to know that there's a massive difference between vacant and available.
Correct.
Just because it's vacant doesn't mean it's available. There's no law against owning a vacant property.
Yeah. I mean, how many people own a second home? I have a second home that nobody lives in. Yeah. It's technically vacant when I'm not there. Yeah.
So I always wondered, well, how is the 15 million vacant homes going to help us? Like, how does that help housing affordability? It doesn't. It's just, I think there were, when I looked it up, Michael, there were 20 million vacant homes in 2008 or so. So there were a lot, 5 million more, but we've always had millions and millions of vacant homes. So there's that theory.
It's always compared to what? Just throw that one away. It's complete garbage and fear created by the crash bros. It's garbage.
Well, and by the way, so the counter to that is, or not the counter, the follow-up to that is that I spent some time analyzing how old homes are in the US, and specifically Ohio. And they are old. In Ohio, 1.7% of all homes were built after 2020.
Wow.
Half of them were built before 1960. So when you get a silver tsunami home, it's like my father's home right now, built in 1950. It's going to need a roof, windows, crawl space work, a kitchen, a bathroom, flooring, basically everything.
Change pipes, wires. Yep.
Yeah. So I'm like, all these homes that may be coming from the silver tsunami are going to require mountains of work. If you're willing to take that on, those could be opportunities. But if you're expecting the move-in ready home and the perfect school system on the corner lot with a man cave, a 4-car garage, that's not what you're going to get, generally speaking. And I'm just curious what you think about that silver tsunami narrative. I mean, Daniel DiMartino Booth talks about it all the time. Adam Taggart talks about it like it's going to be the nirvana of real estate. Just wait. Don't do anything.
It's just another housing doomer. But like when in doubt, they pull out the housing silver tsunami. They pulled it out 3 or 4 times over the last 15 years. It's always another reason it's coming. What I would tell you is, first and foremost, we're living longer. Hello. Second, we have, traditionally speaking, over 40% of homes now are owned free and clear, mostly by boomers, right? People later in life. People are aging in place a lot more. Again, they don't talk about that. People die all the time. And it doesn't crush the market, right? Boomers don't have a clock that they're all going to die, in 2032. That's not how this works, right? And, it's just another crappy narrative. Now, there might be some areas of the country, probably some older areas, where the next generation is not like they're leaving to go to the big city. And yeah, there'll be some towns and some cities maybe that are hurt because they're not getting the migration is not positive, but that's a migration problem, not a, silver tsunami problem. So again, it's just like vacant homes. When in doubt, doomers, crash bros create a scary headline that logically makes sense unless you're in the data like a housing nerd and causes you to do nothing, causes you to wait. I just did a presentation on how to get wealthy in 10 years. And the first slide was all facts about 65-year-olds. Because again, I was raised to get a job, climb the corporate ladder, retire at 65 with a 401k. The fact is that's a horrible strategy for most people, right? Median net worth 65 is like 100 grand. Median net worth of a renter is 4 grand, right? So again, in the society that we have today, with the money supply at record levels, M2, you got to own assets, and crash bros and doomers don't want you to own anything. Right? I think doomers are part of the cycle of own nothing and you'll be happy. That's crap. But again, if you want to listen to the doomers and do nothing and because they make you feel good and give you a big warm hug, you're going to deserve to be broke. Getting wealthy is hard. Writing lots of offers is hard. Doing the work is hard. Being consistent is hard. Choose your hard. I promise you, being broke at 65 is going to be hard. I tell you, building wealth at 40 is hard. But choose your hard.
Yeah. So to that point, let's talk about some solutions. Like, yeah, I hear, obviously, I listen to your daily financial news on YouTube all the time. Maybe not daily, but I always catch up. And, one thing you predicted a while back, which I thought was interesting, was you were like, hey, we will probably not see an explosion of home prices when this thing stabilizes. We're not going to see a huge decline. We're going to see a grind sideways as income approaches. Now, all of a sudden, this morning, or maybe it was yesterday, I can't remember which one, you said, hey, guess what? The time is here that the data is now showing that wages are growing faster than home price growth.
Yeah. Yeah, it was yesterday.
That needs to right. That needs to continue for a few years, right?
This is another one where the crash bros for years, because I called that 2.5 years ago. I said, guys, if you're in real estate, congratulations if you were in it 20 and 21, but we're going to go sideways for 5 to 8 years. Because again, I've studied history. This is just like 78 to 94, just basically sideways. And, again, I was right, even though all the crash bros threw hate at me and they call me a bull. How can you be a housing bull if you say prices are going to go sideways? I don't understand, but whatever. But yeah, affordability gets fixed by lower prices, lower interest rate, or higher wages. And given the cycle that where we are in, with the inventory setup that we are in, the only answer is we grind slowly better by seeing wages. And you're absolutely right. Wages, and this is from memory, so I might be off, but wages were up last reported 4.3%, and housing is up like 1%. So we need wages to outpace housing by multiple percentage points for multiple years. And that's how and nobody likes that answer. All the crash bros want to tell you the GFC is coming back and buckle up, it's going to be a party. It's not happening. We're just going to go sideways for an ungodly amount of time. It's going to feel like forever. And then eventually housing will be affordable again. Yeah,
and you've called that August of this year was kind of the bottom of transactions.
Yeah, we'll see. We'll know Thursday. We'll know Thursday.
Right, and I can see that transactions. It feels like it's picking up a little in my area. As a realtor, I've always been busy, but that's not a fun answer as far as grinding sideways. Affordability will slowly return. I think the other thing, hopefully, we'll see, and you mentioned it recently, is smaller homes being built.
Well, that's the long-term answer.
That'll help.
We haven't had a housing boom since the 1950s focused on entry-level or first-time homebuyer homes. Guys, it's been 75 years since the country has focused on entry-level housing. Why does Ohio have, I don't know what you said, like 20% before 1960? Because that's the last time we built entry-level housing at scale.
50.
Yeah, that's the answer. is building smaller homes.
You can see it in the numbers when you look at how many homes were built in time periods. That post-war home, postage stamp, 800 square feet on a slab.
Yep.
And by the way, those are you don't see them anymore, but they're inside the outer belt of most areas. Hopefully we'll see more building there. And so as we wrap up, if somebody's watching this and they're like, you know what, this sounds great, housing nerd. This sounds great, one rental at a time. You guys already own real estate, yada, yada, yada. How do I do something now? What's the next step I need to take? And everybody's situation is different. I get that. But in general, do you have some words of wisdom for the home buyer out there or even small investor?
Yeah, what I would tell everybody is it's the same story no matter where we are in the cycle. Is you're not supposed to do anything until you can answer the following question. What is a great deal in my buy box? So what is a buy box? A buy box is a set of criteria that produces a finite list of opportunities that you look at every day for 90 days to 6 months. During that 3 to 6 month exercise, your job is to solely figure out what the average return is from your buy box. And let's just make up some numbers. Let's say the average return is 5%. Once you have done that, and only after you have done that, your job is to write good or great offers, which instead of being 5 should be something like 8 or 9%. I don't want you doing average deals. This is why it's hard. This is why it's focused. This is why it takes consistency. This is why not many people do it, because it takes work. Your job should be to only do great deals. And you can't do that until you know what an average deal is. That's why most people aren't good at real estate, because they're guessing, they're gambling. And it's only the people that do the work day in and day out to figure average that can do great deals. That's the answer. No matter where we are today, last year, next year, same answer.
And I would add that even if you're looking to buy a house to move into and you don't want to be underwater, or you want it to be an asset for the future, you don't want to quote unquote overpay, you need to understand those parameters that Michael just outlined, so that when you do look at a deal, you're like, that one will fit my buy box. If it's better than average. And he one of the things that Michael highlighted on a recent episode of his daily financial news was that there are some folks that he's been in contact with that have made 50 to 80 offers.
Yep.
Over a time period before they actually landed one. And that's the type of grind it takes to find something.
Any idiot can pay list price. That's not what we should be doing. Like I told you earlier, it's a tough time to sell. So as a buyer, be greedy. Disrespectful offers, 10, 15, 20, 25% below list. Ask for closing costs, get rate buy downs, get repairs. It is a horrible time to sell, which means if you do the work, it's a great time to buy.
Absolutely. Yeah. So to wrap up, I do have some plugs from Michael. His YouTube channel, One Rental at a Time. It's like the most free education, the most valuable education if you're paying for it. It's unbelievable wisdom, not only from Michael, but from all of his guests. Like the guests that he has on there will make your head spin with opportunity. I mean, it's fantastic. So I recommend checking out One Rental at a Time. The other thing is he obviously has his book that I'll have a link to in the description, but then he has a pretty cool platform called School, or he's on School, which is SKOOL. And I joined recently, and it's where you get together with people that want to do good deals, where you can learn to be a small investor and be successful. And I would recommend that for anybody looking to gain knowledge. And it's like $20 a month. So it's just a few lattes and you're good.
Crazy. Yeah. Thank you, man.
Right. So any parting words, Michael, before we end this?
No, at the end of the day, getting wealthy has never been different. You create disposable or discretionary income, you become an elite investor in something, and then you do it for a decade. Choose your hard. Life's hard.
Awesome. Well said, Michael. Maybe we'll do this again.
Anytime.
Okay. Yeah, awesome.
Anytime. Thanks, buddy.
Thank you.